Welcome to the Cambridge Financial Podcast with Bert Salazar, CEO at Cambridge Financial Partners, LLC. This podcast is all about tax-preferred retirement planning, economics, financial risk management, and achieving a risk-free and successful financial life. Now, your host, Bert Salazar. Bert Salazar. Bert Salazar.
Hey, good day, everyone. Welcome to another podcast. This is episode number 93 of your Tax-Free Life Retirement Podcast. Today's podcast is going to be a very important one when it comes to retirement distribution planning and when it comes to basically just about any topic that you think about when it comes to retirement. So today's title for the podcast is Life Insurance, the Swiss Army Knife of Retirement. And this is one of the topics that I discuss every single week with each and every one of my clients, and also with many of you that come to see me, or we schedule a video conference for the first time, because there are so many different questions when it comes to the ownership of life insurance and retirement, that I thought it would be a very good idea for me to dedicate a little bit of time to this today. Now, I've done one previous podcast, which I did several months ago, dealing with life insurance, but it talked about a different aspect of the usages of life insurance when it comes to retirement distribution planning. So today we're going to be discussing three major sections. Number one, we're going to be discussing some of the misconceptions that you hear often in the marketplace. Number two, we're going to be talking a little bit about the benefits of life insurance at retirement. I'm not going to give you all the information there is to be given there, because we would have to take probably 2 hours to do a podcast, and I'm not about to do that. And number three, we're going to be discussing the reasons why life insurance is in fact the Swiss Army knife of retirement distribution and retirement planning. So let's start with number one, which is life insurance misconceptions. And most of these I hear often, and I hear not only from individual Americans and clients that I engage for the first time, but I also hear from certain advisors that do not have a lot of economic knowledge when it comes to retirement distribution planning. They don't have a tax background. So one of the things that I do on an ongoing basis is I do workshops and educational webinars in order to assist the public in truly getting a clear understanding of the importance of life insurance in a full-fledged retirement plan. So the first thing that I hear at times is you don't need life insurance once you retire. And that cannot be further from the truth. As a matter of fact, I would argue that every single American should own as much life insurance as possible when they hit retirement. And there are many, many reasons. We'll touch upon a few of those during this podcast. But one of the main reasons why life insurance is so important in retirement is that it opens up so many different avenues and opportunities for the average retiree that otherwise they would not be able to. It gives them choices, and choices are very, very important when it comes to retirement, because if you think that the choices that you make at age 65 would be suitable at age 75 or 85 or 95, obviously the world changes. So, I have some additional news coming to you. Those choices are not going to be apropos, 15, 20, 30 years later. So life insurance brings a tremendous amount of flexibility to the table, where by giving you the opportunity to do other things with your assets that, unless you had strong foundation of life insurance in place, you would not be able to accomplish. And I'll talk about those in a little bit. The second thing I hear is that you should always buy term and invest the difference. And this is something that has been around since the early 1980s. One of the major companies that we see in the marketplace, Primerica, uses that theory today more so than any other company in the marketplace. And prior to Primerica, A.L. Williams was the first company that started touting and promoting the buy term and invest the difference. Now, for many of you, term insurance may be important, may be apropos, maybe in the very beginning, the type of planning that you should own, because at the end of the day, insurance can do so many things for you and your family that having term insurance on your side of the ledger is not going to be a bad thing. But when you now take it into a concept, when you now pair it up with investment opportunities and you say that you should always buy term and invest the difference, you're actually following what financial institutions would want you to do. See, they would want you to buy term insurance at a point in time in your life where the probability of death is almost non-existent because you are so young that the probabilities are in the favor of the insurance carrier. Number two, they also want you to invest the difference. Sadly enough, what most Americans do is that instead of buying term and investing the difference, they actually buy term and spend the difference. But also think of it this way, that when you buy term and invest the difference, only about 2.5% of term life insurance contracts ever pay out a death benefit. And the reason is that people usually buy term insurance at a point in time where, the probability of death is minimal. And then by the time it gets to their mid-60s, when now the probability of death starts to increase rapidly, then they cannot afford the term cost anymore, so they're going to drop it, they're going to cancel the contract. And guess who wins? Well, the insurance companies win because they have been utilizing your money. You have been paying a premium for many, many years, 15, 20, 25, 30 years. And at the end of the day, you drop it like a hot potato. And therefore, not only did you lose your premium, but you also lost the opportunity cost of that premium, because had you known that you were not going to be dead within a 25, 30-year period, you could have invested that money somewhere else and get a much higher rate of return than you did by just giving that premium to the insurance company. The other thing is that on the investing the difference side, you see the investment companies always win. Because if the market goes up, they're going to charge you a fee. If the market goes down, they're going to charge you a fee. And if the market breaks even for the year, then they're going to charge you a fee. So no matter what, they're going to be collecting a fee out of each and every dollar that you put away for investment. So they're giving you a combination of products that, A, the probability that they're going to pay a benefit is going to be 2.5%. In other words, 98.5% of the time, they're not going to pay a benefit. And number two, they're going to collect a fee whether you win, lose, or draw. Now, if you were an insurance company, you would love that deal. I would do that deal every single day if somebody would allow me to. But for many Americans, they just follow that process, and it's one that is not going to get them to where they need to be. Point number 3 under misconceptions is that, life insurance is not cost effective. As a matter of fact, life insurance is one of the most cost-effective products that you can purchase when it comes to your retirement, because someone is always going to get the benefit. Someone is always going to get that death benefit, which is going to be tax-free. It's going to be federal income tax-free. So when you start thinking about the premium payments that you make versus the ultimate cost, and I'm not talking about cash values, we'll get into that in the next few minutes, but when you take a look at the premium that you pay versus the ultimate tax-free cost, there's probably no other investment in the world that would allow you to give you that kind of rate of return. And life insurance, by the way, it is not an investment. So that's something that's very, very important. And then the last point under misconceptions is the one that is point number 4, which is life insurance is not a good investment. Well, I just said it. Life insurance is not an investment. What life insurance does, it allows for the acceleration and allows for the acceleration of the distribution rate of every other asset that you have in the portfolio. In other words, if you have a life insurance contract inside a portfolio, that portfolio is going to work a lot more effective, a lot more efficiently, because you're going to be able to get a much higher rate of return and or distribution rate of return on that portfolio because of the fact that you have the benefits of a guaranteed life insurance contract that will pay at any point in time upon your death, regardless of economic conditions, interest rate conditions, market conditions, whether the stock market is up or down, interest rates are up or down, whether you have a lot of personal wealth or you're broke. It is considered to be the great equalizer of retirement. So again, for those of you that may want more information on this, please feel free to reach out to me. You can call me at area code 786-766-1042. You can also email me at Bert, B-E-R-T, at GablesTaxGroup.com, and I can go into a lot more details regarding the Swiss Army knife of retirement. Now let's talk about part number 2, which are the benefits of life insurance at retirement. And all of a sudden, when you start to think about all these benefits that you can get out of a properly structured life insurance contract, you can now see how sad those misconceptions are from the very, very beginning. So let's start with the benefits of life insurance at retirement. Number 1, death benefit proceeds are received federal income tax-free by beneficiaries. So therefore, if you have a $500,000 or $1 million death benefit and you don't wake up tomorrow morning, your beneficiaries, your surviving spouse, your family will receive that lump sum death benefit tax-free. Now, you can actually, in the contract, create some settlement options. Let's say that your surviving spouse may not be as economically or financially savvy as you may be. And instead of allowing that surviving spouse to have $1 million of death benefit or $500,000 of death benefit being paid within a 30-day period, more or less, and then all of a sudden now that surviving spouse has to figure out what to do with that money for the rest of his or her life, you can actually choose a settlement option that will allow your surviving spouse or beneficiary to receive a pension benefit out of it. So they would get a monthly income or an annual income for the rest of their lives, or until the money runs out, depending on which option you decide to choose. So again, the fact that it is an investment that is received tax-free is very similar to the proceeds at death from either a Roth IRA or a Roth 401k. So it is, in fact, an incredible product to have. And most important, it will kind of fix all the financial mistakes you may have made in your financial life, especially in retirement. So life insurance will make you whole. Life insurance will make your family whole. So it is definitely an important product that you need to have in your retirement arsenal. Point number 2, cash account values grow tax deferred. So if you have a permanent life insurance contract, and we're definitely not talking about term insurance at this point in time, the cash values that grow inside that contract grow on a tax-deferred basis. Point number 3, cash account values can be accessed prior to age 59 and a half with no premature penalties. If you have money in an IRA, 401k, 403b, or any type of pension, if you take money out of those accounts prior to age 59 and a half, unless you meet certain exigent circumstances, not only are you going to have to pay taxes on those distributions, but you're also going to have to pay a 10% penalty. So obviously, when it comes to cash values inside a life insurance contract, they avoid that 10% premature penalty that you would have received otherwise. So you actually have the ability to take the money out on a tax-preferred basis and avoiding the obvious 10% penalty. So you do have a lot more liquidity in a cash value life insurance contract that you would have in your traditional IRAs or 401ks. Point number 4, there is no RMD requirement at age 70 and a half. As you all know, if you own an IRA or a 401k or a 403b, once you hit the age of 70 and a half, and we've been talking about these issues for quite some time now, you have to start taking required minimum distributions whether you want to or not. And if you don't take your required minimum distributions at retirement as you should, then not only are you going to have to pay taxes on those distributions you should have taken but you didn't take, but you're also going to have to pay a 50% excise tax penalty. Well, when it comes to cash value of life insurance contracts, you have total flexibility and you have total control of those areas, because you don't need to take any money out of that. So you could have a lot of money inside a cash value contract, and you can allow that money to continue to grow indefinitely and only choose to take it at any given point that you decide to do so, because you have the 3 C's which are so critical in retirement: care, custody, and control. Point number 5. Cash account values can be withdrawn without taxes and or penalties. I think we have just discussed that. So again, I just wanted to reemphasize that point from a business perspective. Point number 6, distributions of account values do not impact the Social Security torpedo tax at retirement. And you guys have all heard me talk about provisional income calculations at retirement, Social Security taxation, the fact that if you don't do it the right way, up to 85% of your Social Security benefits may be taxable in retirement. And that's a big issue, because if you pay taxes on your Social Security benefits, according to the statistics, you will actually run out of money anytime between 5 and 8 years sooner than expected, because if you have to pay taxes on your Social Security benefits, then you're going to have to plug that hole. You're going to have to fill that hole. And the only way you're going to be able to do that is by taking more distributions out of your retirement accounts in order to fill that hole. And on top of that, you're going to have to pay more taxes because now you're taking more distributions. So having a product like life insurance or a 7702 plan, which is what I call it, inside your retirement portfolio, it's going to be an excellent tool for you to avoid Social Security taxation. Remember, in our tax system, there are only 3 vehicles under the code, the IRS code, that will allow you to take money on a tax-free basis and not have those distributions impact the taxation of your Social Security benefits. And those would be your Roth IRAs, your Roth 401ks, and your 7702 plans. So those are things that are very, very critical for all of us and for all of you to understand as well. Point number 6, cash account values are creditor protected in most states. I live in the state of Florida. I love the fact that I have a lot of cash values inside my insurance contracts because of the fact that in Florida it is cash values inside a life insurance contract. They're totally creditor protected. Now, depending on other states, you may want to check with your individual states in order to determine what percentage of those cash values are actually creditor protected. But in Florida, 100% of it is credit protected. Point number 7, life insurance is a self-completing plan. And it is self-completing not only in case of premature death, but most important is self-completing in case of disability. If you have the right tools and the right riders inside of your life insurance contracts and you become disabled, the insurance carrier will now continue to pay the premium for as long as you are disabled or you're in a disability situation, for as long as you live. And that's a critical aspect of having a plan that no matter what happens, is going to be self-completing. You know, what if you were putting money away in your IRAs and your 401ks and you're 50 years of age and you have another 15 years to go until you retire, or 20 years to go until you retire, and you suffer a premature death? Well, you no longer have the ability to put money into those IRAs and 401ks because you're dead. So now you have pretty much disinherited your family because of the fact that now they're going to have to do something else, because the money that they thought was going to be there at time of retirement, whether it was age 65, age 70, is no longer going to be there. So the death benefit proceeds of a life insurance contract will allow your surviving spouse and other family members to continue to enjoy the value of your work, although you're no longer working because you're no longer here with us. So that is one of the most critical aspects of owning life insurance at retirement. Point number 8, death benefit proceeds can be utilized to mitigate the cost of qualified long-term care illnesses. Because of the fact that someone always gets the benefit. And this is one area where we here at Gables do a lot of work. Every client that we engage for the first time, and every one of our clients every other year or so, we do a life insurance audit. And by the way, I also have the ability to do those for you and for any of you that may own a life insurance contract. If you have owned a life insurance contract longer than 5 years, and you have not done any auditing of those contracts, it is very, very important for you to be able to do that, and I'll talk a little bit more about that. But the point here in point number 8 is that if you have the right riders inside that contract, you can actually invade the death benefit of that contract in order to pay for your long-term care needs in retirement. So if you have a long-term care need and you qualify, it has to be a qualified long-term care event in which you cannot perform 2 of the activities of daily living, and we've talked about those. Bathing, continence, being able to move, taking pills, whatever it may be. If you cannot qualify for 2 of those 6 activities of daily living, then the insurance company and the insurance carrier will allow you to invade the principle of your death benefit that otherwise would have only been available at time of death, but because of the new long-term care riders that are available in the marketplace, you can now start taking monies out of those death benefit proceeds in order to be able to enjoy it while you're alive. Not that you want to enjoy it that way, but life is not fair to everyone, so it helps to pay for those long-term care costs and additional expenses that you and your family may have to mitigate at some point in time in the future. And then the last point here, which is point number 9, and this is a very important one because I have been in the financial services and accounting business for almost 30 years. And sadly enough, I have had to deliver a number of death benefit checks to clients of mine that have had premature death in their lives. And I can tell you a couple of things that are going to be very, very important for all of you listening to this call. Number 1, no one ever dies at the right time. Number 2, tomorrow is promised to no one. So I have had death claims of people in their 40s. I haven't had anyone in their 50s, but I've had them in their 60s, 70s, 80s, and 90s. And I can tell you in each and every one of those cases, no one ever dies at the right time. The other thing that I can tell you about the value of life insurance, which is the kind of value that very, very few Americans truly think about. And this is one that brings the value of everything that I do to the forefront every single day of my life. And it is a fact that I have never, ever met a widow that did not believe in life insurance. My mom and dad passed away almost 23 years ago now. My mom died first, and then within 8 months later, my dad passed away. Both my mom and dad owned life insurance. When my mom and dad died, there was a death benefit that was paid to my dad. And that kept my dad going. My dad was doing okay financially. but that death benefit kept my dad going. Sadly enough, he died 8 months later. He also had a death benefit proceed, and that was paid to my family and my children. And there's nothing more precious than someone purchasing a life insurance contract in order to make certain that someone else is going to be protected in case of their demise. There's nothing more subtle, there's nothing more beneficial, and there's nothing more important than making certain that your family is going to be okay, whether you are here or not. So, and I can go on benefits of life insurance, but I just wanted to share some of those. And then the last thing that I want to talk about today is why do I consider life insurance to be the Swiss Army knife of retirement? Well, here are some of the points that I want to discuss with you. Again, number one, it's a tool for pension maximization. Because what happens is if you don't have life insurance as part of your retirement portfolio, you're going to be segmented, you're going to be limited to what you're going to be able to do with the money. In other words, if you have $1 million portfolio, the only thing you're going to be able, if you're married, let's say that you're married and you have a family to support, if you have $1 million portfolio, I'm just using $1 million as a number, you can pick your number, but if you have $1 million of retirement assets at portfolio, you're going to be forced to live on an interest rate environment only. Meaning that in the old days, if you had $1 million portfolio, even today, most of the financial statistics that you hear says that if you have $1 million portfolio, you should not take more than 3 to 4% of that portfolio every year in order to maintain your standard of living, because there is a susceptibility that you're going to run out of money before you run out of life. Well, what happens is on $1 million portfolio, it's all about cash flow. So that means that don't pay attention to the $1 million portfolio. Pay attention to what it is that it will do for you and your family. In this case, at a 3 to 4% payout rate, you and your family will be receiving anywhere between $30,000 and $40,000 of income every year. And then the problem is, well, where are you going to be investing that money? Because at retirement, you cannot be investing that money aggressively, because you want to make sure that that money is going to be there not only for the rest of your life, but that money is going to be there for the rest of your surviving spouse's life as well, from a business perspective. So you have no choice but to live on an interest rate environment. Take a look at interest rates today. You know, $1 million CD in the 1990s used to pay out anywhere between 5 and 6%, so between $50,000 and $60,000. Today, that same $1 million CD will barely pay 2%, $20,000. You're going to have to change your standard of living significantly because of the fact that you thought that you didn't need life insurance in retirement. Now, if you have $1 million of death benefit, and you have $1 million of retirement assets, now you can actually create a pension maximization plan in which you can start taking out anywhere between 7 and 13% out of that portfolio. So we're talking about $70,000 to $130,000, and you can do this on a guaranteed basis out of that portfolio without ever running out of money. And if you happen to die along the way, the $1 million death benefit that you have in your life insurance contract is going to replace a lot of those assets that may have been utilized while you were both alive and enjoying your retirement life. So always remember that when it comes to life insurance, everyone is going to own it in retirement. So you're either going to pay a premium to an insurance company and you're going to transfer that risk of longevity or the risk of premature death from yourself to a company for a premium, or you're going to self-insure. And in this case, if you were only able to take $40,000 at best case scenario because of the fact that you did not own life insurance and you needed to only evade the interest that it generated, then compare that to $70,000 the other way. So that means that insurance contract that you no longer have because you wanted to self-insure it is actually costing you $40,000 a year because you don't get the enjoyment out of the additional $40,000 due to the fact that you don't have a pension maximization vehicle as part of your retirement distribution planning. Another thing that you can do is it's a great tool. Life insurance is a great tool for Social Security replacement. Do you have any idea what percentage of the clients that I engage for the first time that are fairly close to retirement had never thought about how to use life insurance as a way to replace the loss of a Social Security benefit? See, when families are used to receiving 2 Social Security benefits, it's going to be very, very difficult for them to live on one Social Security benefit alone. And for those that don't have that proper protection, here's what's going to happen. The surviving spouse is going to have to dip into additional assets. So he or she is going to have to accelerate the distribution of those assets even more so in order to replace that Social Security benefit income that they were receiving when both husband and wife were actually alive. Now, you would say, well, Bert, isn't the surviving spouse going to take the higher of the 2 Social Security benefits? And the answer is yes. But when you take the higher of the higher of the 2 Social Security benefits, the other one goes away. So it goes back down to the same premises of mathematics. If you don't properly prepare or structure a life insurance contract, at least, and this is at least that each and every one of you should consider as you get closer and closer to retirement. Make sure that you protect each other's lives. If you're married and you're filing jointly and you love your surviving spouse, to have at least enough life insurance that upon your demise, your surviving spouse can take that death benefit and create a Social Security replacement trust for himself or herself for the rest of their lives. So that's important. That's extremely important. But unless I bring it to the forefront and to the table, most of the clients that I engage have never thought about it. And then when I do, they say, oh my gosh, Bert, why didn't I talk to you 10, 15 years ago? What can we do now in order to remedy this situation? Another great benefit of, again, the Swiss Army knife is one that you can use for multiple different things. So what else can you do with life insurance as a Swiss Army knife? It's also a tool for tax-free retirement income. So many of the clients max out the contributions to their 7702 plans in order to receive tax-free retirement income for the rest of their lives, and they can choose when to open the faucet to take that retirement income. They're not obligated to do it at age 70 and a half. They can wait longer. So they can take a portion of their Roth IRAs and a portion of their 7702 plans or cash value life insurance and wait till their mid-70s or late 70s or early 80s, depending on their health, and then start taking distribution from those accounts, again, on a tax-preferred and a tax-free basis. So it is a great tool for supplemental retirement income. Another thing that you can do with life insurance is a great tool for long-term care protection and retirement asset protection. And we have already talked about the long-term care protection because of the rider that gives you the ability to invade the death benefit in order to pay for the long-term care cost. But what it also does is that it allows your family to, or after your death, when you do pass away with the insurance contract, to replace perhaps some of those assets that they had to dip in their retirement accounts in order to pay for additional long-term care needs and concerns that they may have had at some point in time. Oftentimes, you may have a long-term care event, but you don't qualify for long-term care benefits because let's say that you only have one of the 6 ADLs that you cannot perform, but you still need some help with that. So by having a death benefit proceed being paid tax-free, it does allow for the recovery of those additional expenses when it comes to business planning. What's another great option that you can have for this contract? It provides flexibility of asset invasion and or asset distribution choice at retirement. Goes back to my first example with the $1 million portfolio. Now you can pull more. Why? Because now you give yourself the ability, if you have a death benefit amount equal to the amount of assets, now you have earned the right to start paying down principal as well as interest. See, you're no longer married to that option that you only have a $1 million portfolio. You can only pull between 3 and 4%, because if you pull more than that, you're going to have to start invading principal. And when you do that, if you live long enough, you may run out of principal, and then upon your death, you have just disinherited your family without wanting to. See, always remember that the road to hell is usually paved with a lot of good intentions. So make certain that whomever you're working with when it comes to your retirement distribution planning, that you discuss some of the things that we talked about. Obviously, if you need my help, I'm here to help you at any point in time in the future. The other things is you need to understand the product differences. You know, there are all kinds of products available when it comes to 7702 plans and life insurance. So you have term, you have whole life, you have guaranteed universal life, you have variable universal life, you have fixed index products that are life insurance contracts. Depending on your goals and objectives, you have to understand how each and every one of those products is going to work for you and your family. So make certain that you're always speaking to an insurance professional that can itemize your goals and objectives in retirement, and that can give you products that are going to be suitable to mitigate any potential liabilities that you may have along those lines, but most important, that are flexible enough in order for it to be changed at any point in time in the future, depending on market conditions. One major thing right now is the vast majority of companies in the U.S. are now fast changing the ratings inside life insurance contracts. And we have now the CSO 2017 ratings, which are actuarial tables that insurance companies use to determine the cost of life insurance based on mortality. As you know, we are living a lot longer today than ever before. Under the old mortality rates of 2001, compared to the 2017 mortality rates, the new numbers show that people are living a lot longer than they have ever lived before. So the internal cost of life insurance contracts is actually cheaper today than it was 15, 20 years ago. Or even if you bought a contract 5 years ago, you probably purchased that contract. You did purchase that contract under the 2001 rates. So it's important to do an audit on those contracts in order to make certain that the cost of insurance is adequate and apropos for you. But most important, make sure you understand what each product can do for you and how to apply it to your personal situation. Another thing is that policy owners. So if you own a life insurance contract, you must and should conduct life insurance audits on those contracts regularly. You need to find out what the internal cost is, and that's something that we just discussed. Now, if you've purchased a policy in the last several years, you need to do that because right now the cost of insurance is cheaper. So it's important for you to at least take a look at that. Now, if you're not as healthy as you were 5, 10, 15 years ago, then perhaps a product that you have is suitable for you, but you have to do the due diligence along those lines. It is important to do a life insurance policy to determine beneficiary designations. You have no idea how many stories I have heard of husband and wives. They've been living together or married for 15, 20 years, and they get a divorce. One of the spouses remarries, then dies, and the death benefit proceed now goes to either the old surviving spouse or the new surviving spouse if that's not what you wanted to do. So it is important to do an audit of your beneficiary designations in the contract. Also, do you have any contingent beneficiaries? That means that your primary beneficiaries could be one, could be multiple. Upon your death, we'll split up the death benefit proceeds based on whatever amounts or percentages you designated for them. But many times we have a tendency to forget contingent beneficiaries. So let's say in our case, if my wife and I get involved in a car accident, under normal circumstances, I'm 100% primary beneficiary on her life insurance contract, and likewise, she's 100% beneficiary under mine. But what if both of us die in this car accident? Then both of our daughters are contingent beneficiaries, and it doesn't have to be probatable. It doesn't have to go through probate and get a judge to approve it because it is made part of the contract. And in our case, it's a 50-50 split between Crystal and Kelly, so that way there are no issues there. But it is very important that you make certain that you do have a contingent beneficiary when it comes to your insurance ownership. Also, the ownership. Do you have the right ownership? How much in assets do you have? Does it make sense for you to have it in a trust or not? That's dependent on the value of your estate. Lapse probability. One of the things that I do in every single audit is we send out a letter to the insurance carrier that owns that contract, and we have them provide us with an in-force illustration depicting how long that contract is going to be alive. Because most contract owners or life insurance holders do not do life insurance audits on their contracts, and many times by the time they figure it out is way too late. So what we have done is in a lot of the audits that we have done, and we've done over 1,000 audits, and what I can tell you is that 70% of the time I have the ability to put you and your family in a much, much better position, especially from a lapse probability standpoint, than you were before you walked into my office. So why leave it to chance? Make sure that you do a lapse probability audit on your contract in order to determine how long that contract is going to be alive, and if you're going to survive that contract, because you may live longer than that life insurance policy, and that is not what you intended to do when you first purchased it. And then obviously, last but not least, make sure you pay attention to the features and new riders that are available, like the long-term care rider that we've talked about, the disability premium waiver rider that we have also discussed. So when it comes to understanding insurance, and when it comes to determining the fact that it is definitely by far the Swiss Army knife of retirement, how would you go and how do you think you can live a successful retirement life without proper insurance coverage? As you know, obviously, if you want to reach out to me, please feel free to reach out, and then we can figure out whether we can work together or not. But I definitely would be able to answer any questions that you have at no cost or obligation. You can reach out to me at area code 786-766-1042. You can also email me once again at Bert, B-E-R-T, at bertsalazar.com. Well, no, actually not that. It should be Bert, B-E-R-T, at gablestaxgroup.com. I was giving you my personal email again, so don't worry. Just use the Bert at gablestaxgroup.com, and I'll be able to sit down with you. And always remember, I leave you with the same thought every single week, because I have that thought memorized. My job, as I've done today by walking you through the fact that insurance is such an incredible tool in retirement, my goal is to kind of help you and your family change the way that you see things, because when you change the way that you see things, the things that you see change. So again, hope you enjoyed our podcast today. Have a great week, and I'll talk to you again next week, and then we'll talk about some of the other things. And again, please bear in mind that we're fast approaching episode 100, and I'm going to have something very, very special for all of you at that point in time. So I'll talk to you again next week. Take care. Bye-bye.